Macroeconomics concerned with large-scale or general economic factors, such as interest rates and national productivity. Basic economic concepts. Macroeconomics. A. Scarcity, choice, and opportunity costs. B. Production possibilities curve. C. Comparative advantage, absolute advantage, specialization, and exchange. D. Demand, supply, and market equilibrium. E. Macroeconomic issues, business cycle, unemployment, inflation, growth. Business Cylce. Quantity theory of money. Macroeconomics. In monetary economics, the quantity theory of money, QTM, states that the general price level of goods and services is directly proportional to the amount of money in circulation, or money supply. GDP, gross domestic product, equals production consumption, equals win-loss, equals export-import. The Fisher and Cambridge formulations, the style of expressing, macroeconomics. The style of expressing Fisher's transactions and Cambridge cash balances, etc. 5 systems of note issue. 1. The fixed fiduciary, a person hold assets, system. 2. The maximum limit system. 3. The proportional, fractional, reserve system. 4. The proportional reserve system not based on gold. 5. The minimum reserve system. Credit creation in economics. 1. They advance much more than what they collect from people in the form of deposits. 2. Through the process of credit creation, commercial banks provide finance to all sectors of the economy, thus making them more developed than before. Credit creation. 3. The basis of credit money is the bank deposits. Functions of central banks. A central bank has various functions: issue notes and coins and ensure people have faith in notes which are printed, e.g. protect against forgery. Target low inflation, e.g. the Bank of England have an inflation target of 2% +/1. Set interest rates to target low inflation and maintain economic growth. Instruments of credit control. Distinction between goals. Concept of reserves. Cash reserves can refer to the money a company or individual keeps on hand to meet short-term and emergency funding needs. These reserves must be held in the form of either vault cash or deposits in a Federal Reserve Bank. Individuals hold their cash reserves in bank accounts. Liquidity premium. In economics, a liquidity premium is the explanation for a difference between two types of financial securities, e.g. stocks, that have all the same qualities except liquidity. It is a segment of a three-part theory that works to explain the behavior of yield curves for interest rates. Term structure of interest rate. The term structure of interest rates is the relationship between interest rates or bond yields and different terms or maturities. The term structure of interest rates is also known as a yield curve, and it plays a central role in an economy. Fisher equation. The Fisher effect is an economic theory proposed by economist Irving Fisher that describes the relationship between inflation and both real and nominal interest rates. The Fisher effect states that the real interest rate equals to the nominal interest rate minus the expected inflation rate. Monetary transmission mechanism. The monetary transmission mechanism is the process by which asset prices and general economic conditions are affected as a result of monetary policy decisions. Such decisions are intended to influence the aggregate demand, interest rates, and amounts of money and credit in order to affect overall economic performance. Theory of liquidity preference. In macroeconomic theory, liquidity preference refers to the demand for money, considered as liquidity. The concept was first developed by John Maynard Keynes in his book The General Theory of Employment, Interest, and Money, 1936, to explain determination of the interest rate by the supply and demand for money. What are the TVM? The time value of money, TVM, is the idea that money available at the present time is worth more than the same amount in the future due to its potential earning capacity. This core principle of finance holds that, provided money can earn interest, any amount of money is worth more the sooner it is received. Capital structure. The capital structure is how a firm finances its overall operations and growth by using different sources of funds. Debt comes in the form of bond issues or long-term notes payable, while equity is classified as common stock, preferred stock, or retained earnings. Capital restructuring. Capital restructuring is a corporate operation that involves changing the mixture of debt and equity in a company's capital structure. It is performed in order to optimize profitability or in response to a crisis like bankruptcy, hostile takeover bid, or changing market conditions. What are the IS-LM analysis and the role of central bank? The investment/saving is curve is a variation of the income expenditure model incorporating market interest rates, demand, while the liquidity preference/money supply equilibrium, LM, curve represents the amount of money available for investing, supply, and the primary function of a central bank is to control the nation's money supply, monetary policy, through active duties such as managing interest rates, setting the reserve requirement, and acting as a lender of last resort to the banking sector during times of bank insolvency or financial crisis. What is money demand and supply? The demand curve for money illustrates the quantity of money demanded at a given interest rate. Notice that the demand curve for money is downward sloping, which means that people want to hold less of their wealth in the form of money the higher that interest rates on bonds and other alternative investments are.